How are custodial accounts taxed? Have you ever wondered how custodial accounts are taxed? If you are considering setting one up for a minor, understanding the tax implications is essential. Let's break it down in simple terms. Custodial accounts, like those created under the Uniform Gifts to Minors Act or the Uniform Transfers to Minors Act, are investment accounts managed by an adult for a minor. The minor is considered the owner of the account, which means they are responsible for paying taxes on any income generated. First, let's talk about unearned income. This includes things like interest, dividends, and capital gains. For the year 2024, the first $1,300 of unearned income is generally tax-free due to the child's standard deduction. After that, the next portion of unearned income, up to around $2,700 total, is taxed at the child's tax rate, which is often lower than the parent's rate. Now, if the unearned income goes beyond that $2,500 threshold, it falls under what is known as the Kiddie tax. This means it will be taxed at the parent's marginal tax rate to prevent income shifting for tax benefits. Additionally, if the unearned income exceeds $2,500, it may also be subject to a 3.8% net investment income tax. To figure out the tax on unearned income over the threshold, the minor will need to use Internal Revenue Service Form 8615. Next, let's discuss earned income. If the minor has a job and earns money, that income is taxed at the child's regular income tax rates. If their earned income is more than the standard deduction for that year, which is $14,600 in 2024, they will need to file a tax return. Speaking of tax returns, there are specific filing requirements. If the minor's unearned or earned income exceeds certain thresholds, they may need to file a separate tax return. However, if the unearned income is below around $11,500, parents can include the child's income on their own tax return. It's also important to note that contributions to custodial accounts are considered irrevocable gifts. Once money is put into the account, it legally belongs to the child. When the child reaches the age of majority, which varies by state, they gain control of the account and can use the funds as they wish. Some custodial accounts may even be linked to tax-advantaged savings plans, like Custodial education savings accounts. These accounts offer tax-deferred growth and tax-free withdrawals for qualified education expenses, but non-qualified withdrawals might incur taxes and penalties. Banks and credit unions play a role in helping families set up custodial accounts while ensuring compliance with tax regulations. They keep detailed records of transactions and may act as custodians for tax-advantaged plans. In practical terms, it is always a good idea to consult a tax professional for personalized advice. Tax rules can change, and individual circumstances can vary. Understanding how custodial accounts are taxed can help families make informed decisions about saving and investing for minors.